Good afternoon. This is Kim Gertis. I'm standing in for Dave Durham today. This is the Six Figure Portfolio Coach. It's the live trading session. It's Thursday, May 29th at noon. Welcome, everybody. Hope you're having a good day. And we are almost ready to go. With attendees are still coming in a little bit, but I think you can get started, Michael. So I will turn it over to you in a second. Just a reminder to everybody, this session is recorded and will be posted on the website later along with the trades. Thanks very much. It's all yours, Michael.
Thank you everybody for dropping in. And today, sort of the theme of the week was putting it all together. What I want to do today, and these are potentially real trades for you, is I want to look at three trades on the same stock, U.S. Steel. And there are three different positions that I want to talk about, and actually I've changed that chart as of the last half hour. It shows what happens with the speed of the market.
Hey, Michael.
Yes?
We're not seeing your slide or chart, whichever.
Okay. I'm sorry.
That's okay.
Are we seeing it now?
Yes, we're seeing.
Okay.
Yep, a weekly trade session.
Yes. And instead of a buy right and a covered call and a leap and a covered call, obviously if you don't own the shares, it's going to be a buy right. I also want to put a simple put into the mix because the way the stock has moved in the last hour or so, which shows how fast things can do. I also want to put a little wrinkle in. I want to talk about a tactic that we've never discussed. And the point of it is you could make the trade, but it's also to illustrate that hopefully if the details and the materials in this coaching program have even in part sunk in, you realize that there's more and more you can do just with the simple concept of selling a put or selling a call. And so I'm going to switch over right now to a chart of U.S. Steel. Excuse me. I'm going to go over and call it up. And this is the chart of U.S. Steel for the last 6 months. Are we seeing this, Kim? Hello?
Yep, we're seeing it, Michael.
Okay, I just wanted to make sure, given the other problem.
Sure.
And you can see that this is the chart that I just called up for a year. And let me talk about fundamentals for 30 seconds. Then we'll look a little bit more at the charts, and then we'll go right to my calculator and walk through the trades. U.S. Steel is a pick that's derivative of a fracking boom. It has an enormous growth in specialty steel. Steel is consumed in large amounts in fracking fields because the fields move. They're not a set well like it would be for 5 years or 10 years or what have you in a different kind of field. In a shale formation, you're moving every 3 or 6 or 9 months. And also pipeline construction. There's also, not the beginning, we're about in the second inning of a very, very large boom of core industrial products in the United States, projects, refineries, petrochemical plants, ethylene plants. And we are going to have an infrastructure boom in the next, 18 to 36 months. No insult to anybody. After the first road or bridge collapse that affects the relative of a member of Congress, they will finally pass an infrastructure bill that will take care of some of the decaying infrastructure. This is all good news for U.S. Steel. The stock is very volatile because it moves on headlines about China and about worldwide steelmaking capacity, but more and more of its business is completely unaffected by China. It dropped down a couple from up here because wrongly the Federal Trade Commission is allowing Korean companies to dump the kind of specialty steel used in fracking at below market prices, saying it's not below market prices. We all know they are. And the bottom line is it's hurt the stock, but it's stabilized around 24, and I think it's a good place to take a stand and to make some money. So let me go over to the calculator and show you what I have in mind. There are 3 potential positions, and someone scream if you're not seeing an Excel spreadsheet. There's a put, there's a buy right, or simply buying the shares for the long haul and selling covered calls. And there's something you've never seen and we've never discussed before, which is to build a leap in covered call position. And again, this is a recommendation, but it's also a potential recommendation, but it's also a way to illustrate what you can do if you want to be very conservative, but you also want to be aggressive in terms of generating income. If we take a look here, these are the prices as of about 5 to 12 of the different put positions. Now, I'm laying out 3 different expiration dates. This goes back to what we discussed on Monday evening, which is do you already have 2 weeklies out there? Do you already have a lot of Junes? And you can see there are different potential rates of return. Now the green on the right, the ITM, is in the money. These are all in the money puts. So for example, if you sold the $24.17 and got a 17-cent premium, let's say you sold not one contract, but let's say 10. So you're collecting $170. You're probably going to want to put in a good until canceled order to buy it back. If the stock continues to hover up here at $23.95 or so tomorrow, because it's kind of probably hit 24 and have a hard time breaking through. If you really don't want to be put the shares, and I think there's nothing wrong with being put the shares at 24, you would want to be able to buy it back. So these are the different rates of return depending upon the positions you select. The logical choice here is and I'm going to highlight it. The logical choice here is the June 24. I think the stock is going to continue to run. It's a very high rate of return. It does, and the rates of return are calculated here not by a month but 17. The June expiration is roughly 3 weeks from now, and so I'm maybe being a little aggressive in calculating the rates of return, but I'm considering this to be a 3-week trade. So that's almost a 49% rate of return. You have plenty of opportunity. If the stock goes back to 23 or 23.50, you'll be able to buy the put back with a very nice rate of return. You could probably, if for some reason the stock spiked next week, you could probably buy this back next week. So do not assume with a June or even a July that you're locked into the position. If you're a real bull on the stock, and the stock has a lot of overhang at 24, in the 24 to 25 range, you could even sell the 25. But if you're looking for that 48% rate of return, the better play is the June. So write this down. We're going to take one look at prices before we leave for the day and redo the spreadsheet. But right now, based on these prices at 5 to 12, this is a simple put. So I'm going through the example quickly. We're going to slow down when we do the buy right, but that would be the recommendation if all you want is a simple put. As you can see, the May week 5s are in the money, and you would probably have to buy them back. It would need to be a reasonably large trade for an efficiency and commission. I don't know what your preference is, and I prefer this rate of return. Let's go to something a little bit more complex, but is the same thing as having a put. This could be a buy right, or it could be a buy and continue to own the shares and sell covered calls. I do think the shares are going up, and I do think that in essence, if you sold one of the positions here, it's the equivalent of a buy right. Right now, as I said, the cost per share, and we're going to stay with the 5 to 12 prices. It's about $23.96. The first thing you would do is you buy the shares at market, and it's a very liquid stock. There'd only be a penny or two in between the bid and the ask. The second thing you would do is you immediately turn around and you would sell a call. And what you need to understand is you have to ask yourself, how long do I want to own it? How long do I want to be in the position? And remember, depending on the movement in the call, you can always liquidate the position with a profit at any given time. It's just a matter of doing some calculations. So these are the appropriate numbers. You can see, other than one, this one, the July 25 is not a great annualized return if you're not called out. However, if you are called out, because you bought the shares at $23.96 and you'd be selling them at 25, it has the most rate of return. The July positions are calculated based on doing this 7 times a year. It's a little less than 6 months, so the calculation is, it's actually 7 weeks. So the calculation is you would be able to make this trade 7 times a year. That's where the annualized return numbers come from. So let's step through this again. I know I went quickly last week. I got a couple of emails about stop being a Brooklyn guy and to slow down a little bit. You buy the shares at market, then you make a choice of what you're most comfortable with in terms of time frame if you're called out and if you're not called out. And many of you may want to be called out. So if you want to be called out, and I think the stock is going to rise, this is the trade for a true buy right, as opposed to holding US Steel for the next 6 months or a year. The true buy right here is buying the shares and selling the June $24 calls. You have an opportunity with this, if the stock hovers where it is, between $23.50 and 24, you have the opportunity to buy this back as just a straight call trade and then to liquidate the shares if the multiple transactions are profitable. What I want to do before we go to the leap, I want to go back to the stock and back to the charts and see where we are, because this is live trading after all. Screen share. And I want to see how we're doing. We're at 24. So those call prices have gone up. Let's go take a look. And the June 24 is now 67. The June 25, the July, is now 67. So they've gone up a little bit, but they've gone up commensurate with the movement in the stock. There's no disparity, and that's what I was checking. Now, why have I focused on 24? I'm going to do this before we go to Leap, because it's very, very important. I focused on 24 because you can see here that 24 has provided support even when there's a bump in the headlines right here. When you go to 3 months, you can really see that 24 is a very nice place to take a stand. Barring something that I really couldn't foresee, because earnings are a distance away from now. It's hard to imagine that you wouldn't have time to extricate yourself from this position if you start to see more headlines. There's nothing untoward. Anything can happen with China, whatever, and I have said that when you do a play on commodities, even if a lot of their profit is from the non-commodity part of steel, you have to suffer through headlines. The benefit of that, of course, is the volatility with the headline that comes with the headlines, and that volatility in turn creates the premium that we like. Plus, you have the advantage of multiple contracts. It's a relatively low-cost stock. So you can see where I keep on focusing on 24, and you can also see where it's building this base back at 24, and you can see it did not want to stay down here. It just didn't want to, which is an even better sign. And now we're coming back to 20, and it could fill this gap over here. So what we're really taking a look at is this is a very good place to build a position. And remember, I'm a long-term guy. Trade in and out. You may do buy right, but you'll be keeping an eye on it. This is one of my bullpen stocks, so this is a good place to go. So let's go back then, to the calculator, and I'll show you this new kind of trade. And I'll tell you the genesis of why I'm doing it, in addition to its value as a potential trade. This is what you would call a leap call buy right extended, for an extended period of time. Some people would call this a spread. I mean, technically, a broker would call this a spread. And as you know, I certainly don't like spreads involving puts. A spread on a covered call is a different story altogether, especially when it's a stock spread, not an index spread. But I don't even consider this a spread, because usually spreads have what I call a hole in the middle where you can actually lose money, especially if it's a put spread. Let me explain this before we go through the numbers. A leap is a long-term call or a long-term put. These expire in January of 2015. Leaps became popular not just because of the time horizons, the amount of cash you could get from selling them, but if you have a leap, like you could do a January 2016, and if you do something with a January 2016 leap and you buy it and it goes up and you sell it after a certain period of time, you're holding it more than a year, you have long-term capital gains treatments. And leaps have been around for a very long time. That's what a leap is. It's just a long-term option. In this case, what we're doing is we're leveraging our capital. What we're trying to do is do the same trade and get a bigger bang for the capital that we're committing to the trade. And how do we do this? If you buy a leap, and in this case it's the U.S. Steel $15 leap. Now U.S. Steel, when it got hit within the past 2 years, it never, I think you've read about this in Options Income Blueprint, one of our more successful long rolls was in U.S. Steel. I think we had to roll it for 5 months. I recommended, I think, a $21 or a $22 put, and it blew up like 5 minutes later, like the gods of the market were out to get us, us. And 5 months later, it closed with a very, very nice profit because it was all headlines, all China, all news all the time. And it never really got below around 16 bucks, and it really held like a rock. And it's a fundamentally good company, not a great company, but a pretty good company in a great market. A very nice combination. So 15 plus the 15 leaps are very, very liquid. There's a lot of contracts outstanding. So I really like the 15 leap as a place. I thought it would be untouchable. The stock's not, in my opinion, the stock's not going to go below it, and therefore, you'd be doubly underwater. Now remember, if you're buying a $15 leap, which entitles you to buy the shares at $15 a share, and you're paying $9, you're paying $24. You're paying the current market price for the stock. But what it does is it leverages your capital. So from a math point of view, you're really paying the same amount for the shares, but you're not using as much capital. It's a critical difference in terms of goosing, if you want to use that term, the rates of return on a trade. And you can take a look at the math right here. So it's the same if not called out, if called out. And what happens is if you're called out and someone exercises, you have to exercise the leap, which means you buy the shares and then they go to the person calling you out of the call. And brokers are used to doing this. This is new vocabulary for some of you, but it's not new for people. And so you can see how the rates of return have skyrocketed, even on the Julys, because we're only spending, not using $900 in capital, okay, compared to using $2,500 before. So you're getting, very, very much larger rates of return. And it's very, very important that you come to understand that this is a way to leverage your capital. This is a way to make most. Now, there's a flip side to this, which is theoretically, if there was a market crash, okay, or something really untoward happened with the company, leaps expire and they lose all their value. So before that would happen, you would obviously sell it, but you can lose a lot of value. But if the $15 leap, for example, which you're paying $9 for, let's say the stock crashed and lost half its value to 12. And the day it expires, it's still worth $3. So, it's worthless. So you would be losing. You'd exercise the leap, and you'd be down the amount of money that the stock was down. Was the point? So this is about leverage and leveraging your capital. You're essentially, if you do it in this way, you're still paying the same price as if you bought the shares. You're just able to make and create more profit and income and cash for yourself because of the leveraging of capital. I'm not going to necessarily recommend one of these because they're so new, and I think that would be inappropriate. But I put this in here, and I'd like you to ask questions about it. My portfolio coach, we're going to get to questions in a moment about this. Some of you may be familiar with this and may like the numbers and may want to do this right now, and that's up to you. But I wanted to give you a hint that we'll be discussing in a very cursory way some advanced tactics on Monday, things just did not have a time in a 6-week session in the boot camp to go over. But I'm trying to encourage you to be aggressive and be creative, because this, again, is very low risk. It's hard to imagine the stock going below in a certain price, and it's hard to imagine these expiring, you letting them expire worthless. This is another way to look at things. This entails technically a little bit more risk because it's a leap, but essentially it doesn't. I mean, to my mind, it doesn't. And at its core, it's a way of leveraging capital and really dramatically increasing your annualized returns. Now, next week in the session, and we'll get to questions, I'll be putting out cheat sheets on most of the things we've discussed if they haven't been already put up on the site, just to make sure you have a hand. The 4 different kinds of trades. I'm going to add this, and I'm even going to add some bullet points and some other kinds of advanced tactics. But I wanted you to start thinking that you'll be on your own in a week or two, other than emails for a while, and you need to, if you're getting comfortable with the material, there's always more that you can do to leverage your capital at a minimum. Always more you can do to find a stock. If you pressed me and asked, sort of what was the best way to do this, because this is new to you and so forth and so on, you're going to take the shortest term trade possible with the highest amount of premium. So you're going to want to do that. You're going to want to focus on Junes, and I have different premium actually here at the 63 and 65. It's just I'm typing them in at different times. But it's essentially the same rate of return, because if you're called out on something like this, you're locked into buying the shares through your leap and so forth and so on. But the bottom line here is, if you're going to do something like this, do it short term, and I would even dry trade it. If you've never done this kind of a position, I would virtual trade it, and I would not do a real trade with real money until you become more comfortable with it. So let's get back and let's go check the screens, and then we'll talk about the 2 real trades. Let's go to Options Express and see what's doing with U.S. Steel. Yep, it's going up, and it's probably going to hang around here. I'll even check the chains for a moment. I like the June 24 put. which is no longer in the money, by the way. It's about the same price. You can see time decay has already eroded, and the prices were pretty much the same. So what I'm recommending, if you want to do something very close to the strike price or in the money, I'm recommending selling straight up old-fashioned options income blueprint position, sell the June 24 U.S. Steel put. I would put a good until canceled order in to buy this back at, I'd buy this back at 20 cents. And depending upon how efficient you are with your commissions, that'll still yield a return of about 36% on an annualized basis. And if you want to put in for a quarter, there's a little trick you can do. Just take out the good until cancel. So that this is 69 cents and you're buying it back for a quarter. 69 cents minus 25 is 44. You'd have a 31% return with a good until canceled order. And I'm going to do an updated position calculator for you. For next week, and it'll have how you. It's part of performance tracking and measurement. You'll see the different impact of different good until canceled orders on everything. So that's the position I like. It's the June 24. It hasn't changed since when I set up these numbers about 5 or 10 to 12. For buy right, we now have 24.03. I'm recommending. Let's see where the calls are. Let me go back. Excuse me. Let's see. The June 24s are at 60. Yeah, they really haven't changed that much. So let's go back to the calculator. And I'm recommending you buy the shares at market and sell the 20 most. This was fixed. I typed it in, and this isn't a completely live calculator. The return will probably be about 43%. I'm recommending, again, in June. The only thing that I would caution against is concentrating your June positions too much. If you have too many June positions, because that's what I've been recommending, you may want to consider the July. You have up here the June has superior returns. The July does not, unless you're called out. And you can't say whether the stock's going to go to 25 in July. It could be a rough summer. But if you are called out, it's 50. If you're a long-term believer in the shares, okay, I'm going to put these under a different color. Okay, this is for, let's call it a long-term believer. Okay, then this would be a position you'd have to consider. You'd buy the shares, you'd collect a very nice premium, you wouldn't look at it for 6 or 7 weeks and see what happens. But these are the two trades. It's buy it at market and sell the June 24s, or sell a simple put on the June 24s. I really want to focus on that $24 price. That's pretty much it. I hope you saw that if you take a look, you had 6 choices here. You had 8, and with this you really had 10 different ways to play one stock around a $24 price point. And this hopefully is one of the lessons you'll learn, that you'll find what works best for you in this whole universe of different strikes and expirations and tactics you can use. So Kim, if there are any questions, here I am.
Okay, Michael, thank you. I'm looking right now. I don't see any questions.
Well, such a shy crowd.
Or they're busy making the trades. I'm curious, how can people type a yes if you're in the process of making those trades, or you're going to do one of the trades? Anybody? Yeah, okay. Here are a couple questions coming in.
Okay.
From Phil, if you are called out, does the broker automatically exercise your leap and stop trades?
I would call the broker, your broker customer service, but 99 times out of 100, that's what will happen. But you need to check before you enter the trade. That's why I'm saying I suggest you virtual or dry trade this and get all the nuts and bolts down. And this was an illustration, and that's why I didn't make a firm recommendation. I'm really just trying to encourage you that using this coaching program as a foundation for doing what I consider to be extremely conservative, a $15 leap, very aggressive, potential over 100% annualized return trade, that wonderful combination. But do your homework first with your own broker and see how they do it, and see even if you need to fill out some more forms in your account to be able to do this.
Okay, good, thanks. From Dan, he's saying, help me understand the premium and the cost, the $9 cost to buy in the LEAP.
Oh, sure. Let's go to the...
Help him understand what the premium is and
Sure.
what the $9 cost to buy is.
Sure, no problem.
Mm-hmm.
Let me know. We should be on screen again at Options Express. Are we?
Yes, we are.
Okay, so we're now in the LEAPs, January 15, and to buy a $15 LEAP is cost you $9. You're paying it, you own it. It's your right to buy the shares at $15. You can buy them tomorrow at $15. That's the same thing as buying a call that expires tomorrow. It just has a longer expiration date, and because the expiration date and the price that you would buy the shares, it has a higher premium. This isn't premium you're receiving. This is premium you're paying. So you're paying $9 to be able to essentially buy the right to buy the shares now between the third Friday of January at $15 a share. That's what a LEAP entitles you to do. It's the same as if someone came to my house and said, I like your house. I won't be able to buy your house until I get a mortgage next January when I file my Schedule C for my new extremely successful business that no one believes is successful until I file my tax returns. So I'm going to pay you a certain amount of money to buy the house in January. And that's what a LEAP is. This is saying that any time between now and January, not just January, now and January, I can buy the shares for $15. I'm paying $9 for the right to do that. But because this gives you the legal right to acquire those shares, it can be used as the collateral to sell a covered call. Hello?
Sorry, Bill is asking, does it have weeklies?
Oh, sure. There was a weekly put, and let me go back to it. Yeah, there are weeklies. If you take a look right here, the $24 weekly put is selling for 17 cents, and the $24 weekly call is selling for 17 cents, which means there's divided opinion about where the shares are going, which is perfect for people selling options. It's absolutely perfect. There's no bias here. It means you're going to get a little bit more, even though these are pretty liquid. It's really, really clean. So yes, there are weeklies on this, and we've traded weeklies and options in Blueprint and US Steel on and off for 2.5 years. So yes, and as you can see, their weeklies, they're beginning to open up for the following weeks. There's no volume. Well, there's beginning to be some volume in them. Now, this is very interesting. If you look at the June week 1, you have open interest of 1,100 calls versus only 28 puts. And that's an indication that there's an event that I may have missed, which I don't think I have, that's coming up next week, or someone was just hedging a position because they're reporting out their results of their hedge fund or their mutual fund at the end of May. There's a whole bunch of things that would do this, and you can see that we're much heavier here, but it's not consistent because there's 500 puts here. It's people are clearly leveraging and hedging positions. If you go out to June week 2, which is almost to the end of the month, you can see the volume drops off, but you can see someone hedged a position and bought puts at 24.50. So the bottom line is, a lot of the times when you go out to these future weeks, there's no volume, especially on a Thursday. But with US Steel, big important stock, not as big as it used to be, but a big important stock. A lot of people keep an eye on it, and therefore people, mutual funds, hedge funds, they hedge their positions. But yes, there are weeklies, and if you remember, let me go back. Where's my X? Oh, wrong one. Get used to this probably a year or two from now. Here we go. If you remember, the first trade I recommended was this June put, but we also have the May puts. Okay, so there's a May put. I mean, there's these two May puts were things you could also look at. But I had recommended a June. I just was more comfortable with it. And so forth and so on. The May week 5 at 24, you'd have to have a fairly large position to be able to efficiently buy it back, although you could roll it. But if you wanted to buy it back tomorrow, to make the commissions worthwhile, you'd need probably at least 5 or 10 contracts.
Okay, thanks, Michael. Hey, Dan came back with a kind of a follow-up question. Maybe you could go back to the spreadsheet you were just looking at with the trades on it. And
Okay.
Dan, I think there's still some confusion about the cost of the premium because he says, but on the chart, this is Dan had asked about the LEAP, but on the chart you show a 63-cent premium.
But that's the premium for the call you have sold.
There you go.
See, your cost per share, I should change to cost per leap. And the cost per leap is actually $900 per contract, so that's why it's cost per share. This, okay, this cost per share is the premium that I just highlighted on the Options Express. That's what this is what you're selling the call for. So my apologies if there's a confusion in terminology. This is the cost per share in the leap, and maybe I'll type in leap cost per share. And here, we could call this call premium or something, just to make it a little bit simpler. That's the difference between the two. They're very different. It's what you're buying, essentially buying a stock or buying the right to buy the stock is up here, and what you're getting when you sell a call is down there.
Okay. Very good. Bill says thank you. It looks like a few people have jumped into the trades, so that's good.
Any other questions?
I don't see any more questions coming in.
Okay, so I'll wrap up, and what we'll do is I will go back to our little, hopefully unboring PowerPoint. There we go. There we go. Let's start next week on Monday. I'll go over obviously all the trades that we have outstanding. I'm going to emphasize performance tracking and measurement, and just to give you, because I want you to load up with questions, and I've teased you all about not asking a lot of questions, but actually it for the size, the intimate nature of this group, it's the normal amount of questions one would expect. But I want to go over performance tracking and measurement because it's really critical. I mean, you don't know how well you're going to do until you know how well you're doing, and there's a different way of doing it when you're generating income. It's a very different approach. And it supplements, it doesn't replace your current way of measuring your portfolio. It's a supplemental approach, but it's critical. I'll be presenting 2 real-time model portfolios of things that either I own or in my portfolio, or I'm recommending for the great big wide world over there. And we'll do it along the 100,000 and the 250,000 lines in terms of shorter term versus longer term focus. I'm going to give you a very brief overview of some tactics such as the leap call spread, the leap call position, if you want to call it that, just to encourage you to explore and encourage you to use conservative but more aggressive tactics once you become comfortable with them to generate more income. There's going to be a survey. What did you think of the coaching program? What we could do better? What you like the most? And please, I'm anticipating a shorter presentation and longer questions like the live strategy sessions on Options Income Blueprint. I really want to go at your favorite stocks. What do I think? And if you send them in advance, either to me directly or to service at tradersreserve.com, I'll be better prepared to answer questions about specific stocks, if not necessarily specific positions in your portfolio. So thanks for listening. We got this in 35 minutes, which is nice. Enjoy your weekend. And the last note is I received some very nice, very kind emails about the update yesterday, and I just want to thank any of you out there who actually wrote those kind emails that I appreciated. Getting that kind of feedback I find always to be encouraging. So thank you all very, very much.
Okay, thanks very much, Michael. That's it. Again, the session was recorded. You'll find it up on the website along with the trades. That's it. Everyone. Oh, hang on. One question just came in.
Sure.
Daniel in Mexico was finally able to connect for a live session. Thank you. So glad you could join us, Daniel. Anyway, that's it for today, folks. Have a good weekend, and we'll talk to you on Monday.